Hello, this is George Sandman. I'm the founder and CEO of Growth Drive. And Growth Drive is a system used by business advisors to drive client profits, growth, and value. Now, we're also a community. Every week we get together to talk about all things business advisor, everything clients, cases, things we're seeing out in the world. Now, tune in here to this podcast, and you can join the conversation by scanning this QR code, passcode 867-5309. Jump into the conversation. Everyone's welcome. We're looking forward to having you. So here we go. On with the show.
Hey, Joseph. How are you?
Well, thank you. And yourself?
I'm good. Good. Day before an out-of-town trip, so it's always a little discombobulated.
I hear.
Can you hear me?
I can hear you perfect.
All right, good. Yeah. Oh, man. Raining like crazy here. Finally.
Finally, we've had plenty of rain up here in the Northeast. We'd be quite happy with
1 sec.
Well, we've
rain.
been under.
Good morning.
We
How are
just
you guys doing this morning?
Good morning, George.
Yeah, we just left severe.
Turn up volume. Can you hear me?
Yeah, I can hear you.
Bump up the volume. There we go. Okay, I've got somebody's in their car and wants me to invite them. Invite. Copy invite link. Crying out loud. That's
Mr. Owen.
I was just crying
Eric,
out loud. Thank you for recognizing it, George.
all right. John Carter wants to join. And hey, Paul, how are you?
Fabulous. Good morning.
Where's your red jacket?
Telling you, it's a thing.
Yeah.
Right there.
All right. There we go.
Now it's a party.
I mean,
I love this. It's hanging on the handle of a vacuum cleaner.
Hey,
If-
man.
if the Masters is going to have a green jacket, then I think Growth Drive needs to have the red jacket.
Hey, I like that idea. It goes with the red F1 there.
As long as it's
Behind
scarlet,
George.
scarlet gray accents. That's what it needs.
Scarlet. Yes. It's not red. It's scarlet.
Yeah. Yeah.
I don't know. I could give you the hex code for the color.
Yeah. RGB.
I go mostly with the hex colors.
So you
rather
go with
than
hex? Okay.
RGBs. So both. Yeah. There's too many different ways of keeping track of colors.
Yes, there are. Try having your house painted. You get this whole book of colors and
I think it was a year ago this month that we painted the front door entrance,
yeah.
and trying to get my wife to even go out and look with me with the little paint chips from Sherwin-Williams against the siding to see, which she would like or not like and stuff was a hassle. And she kept warning me that if I don't like it, can we repaint it? Well, yes, but I'm not going to do that again. So anyway, she likes it. It worked out. Thank
Very
God.
good.
God bless you, Joseph.
Thank you, sir.
Hey, Wayne.
Hi.
Wayne Lorgus, good morning.
Good
All right, guys,
morning.
sorry about that. I was trying to help John Carter. And
Get on.
he'll be on. How's everyone doing this morning? We got Larry P.
Good.
Miss.
I'm having a prince of a day.
Oh,
Here we
Oh, God.
First time I've ever heard that, Eric. Yeah, I'm sure.
You guys with normal last names are actually lucky. Try having Prince or Sandman.
Sandman.
You never get away with anything, do you, Larry?
hey, but you've got a song to go with yours, George.
That's a fact. You know what? Now that so much of the call centers have been offshored, it used to be that I would get some very nice person would sing that essentially every time I made a call.
Oh,
You know, a
right.
call center. They could call Amex, you call Delta.
Mhm.
Now, of course, those have been offshored. Great, right? Global economy, no judgment. But they don't know my song.
Well, some of that, I'm afraid, George, is age. I mean, that song was
Fact.
before you actually.
So you know what I get all the time now, though, is Enter Sandman. I'm like, okay,
That's
well,
a
different song.
That's the song you're referencing, right? Because that's a real song by Metallica.
that's the real song. So what's on everyone's mind this morning?
Death metal.
Well, I just I am doing a presentation next Monday for EPI and I'm reusing the case study that I presented in January, George. So you'll appreciate that. And Larry heard it as well. Our case study group has paid off in spades for me because I got to reuse the case study and repurpose it for another thing.
So you're doing next week's mastermind?
I am.
Oh, nice. A
Eric.
reason to attend.
Eric, there's a very good bottle of wine and you mentioning strategic capacity at least this many times.
Well, actually, the Claude helped me do I took the case study, I made slides out of it because I'm not going to present it the same way.
It was a
And-
great case, by the way. Really
yeah,
well.
thank you.
Yeah.
It is a great case, and it's why I went through about 5 or 6 different clients, and I said, you know what, that one was so good. Let's just repurpose it. And I had Claude put a slide in defining strategic capacity first, because the audience isn't going to know as well what they'll understand the 2 words strategic capacity, but they won't understand it in the context that we want them to understand it, right? I learned that lesson, by the way, in Slovenia. I was working for Johnson Controls, and I was out on the floor talking through a translator to somebody, and I said, "What's the lead time on this item?" And the translator looked at me, and I said, "Lead time, lead time." So she translated that literally to the person, and I got back an answer that didn't make any sense. And I realized, oh, I'm using jargon. I'm using words that to us together have a meaning, right?
Well, and lead time isn't exactly biz blab, right?
Right, right. But it is jargon, right? And so I explained, I'm looking for the time it takes from the time you order it to the time it comes. Oh, and then she translated that, and the person gave me back the answer, and I'm like, oh, okay, now I but we hear words like strategic capacity, strategic intent is actually the word I have defined at the start, because we talk about the strategic intent, and I talk about it in this case, right? And we'll talk about strategic capacity as well. But we have to be careful, because people will act like they know what it is, because they know the word strategic and they know the word intent, or they know the word strategic and they know capacity. But when we put them together, they have a different meaning.
Welcome
Right?
to my life with the word referral. Welcome to my life.
Yeah. Yeah.
Hey, can we do some cleanup of business from last week?
Yeah.
Mr. Frasco,
Yes, sir.
venture forth with promise document.
George, last week we were just touching on some compensation planners for the executives of a company that kind of drives, I think, what we all want. And I thought I would share it with you guys if that makes sense.
Love that.
Yeah.
Please.
Let's do it.
Okay.
Joseph, I have to say you look very well. You look particularly well. I don't know if you're happier or, but I mean, you've never looked morose. Don't get me wrong.
Thank you.
But you look particularly well. That's meant to be a compliment. I think I just butchered that. You look great, man.
Take the
Thank
foot
you,
out of the
thank you.
mouth.
I think your makeup crew got it right today, Joseph. That's you're right. The right
Joseph,
amount of
sorry to
powder on the.
interrupt.
Yeah.
All right, just let me know if you guys can see this, because I have
It's
a
coming out.
very, very, very large screen, so I'm going to kind of make it larger. So I actually have an application that does this, but I think it'd be easier to share because with an Excel spreadsheet, because it's easier to see. Just let me know when you guys can see it. If you need it
It's up.
larger, let me know.
We can see it. It
Up.
looks good.
Yeah, it looks great.
Okay, so basic ideas is following: that when you're trying to drive executives towards a common goal, it has to be clear to everybody that's involved what that goal is and how they're going to be compensated within the context of that goal. And if they're not all aligned and quite frankly sharing on the alignment, then what ends up happening is typically, which we all experience, is that operations has one set of goals. Marketing has another set of goals, finance has another set of goals, and they're not really working together. So the question is, how do you align their direction as well as their compensation together? So over the years, I built this, and it has seemed to work out really, really well. And here's essentially where we are. So for me in particular, the KPI that I typically tie compensation to is normalized operating income. At the end of the day, it's really what's the growth in the ability of the company to be able to finance all the other decisions, whether it's fixing the foundational work or capital expenditures or distributions, right? So from the perspective, my sense is that this is really the key KPI for them. So normally we just put in over here, let's say the current net operating income is $1 million, whatever it is, right? And you decide that you want to put a pool of capital available for bonus and compensation to the group. It could be 10%, could be 5%, could be 8%, whatever it is that you decide. So that's kind of where it's going to set up. Now, I'm going to talk here about the waterfall between the executives. It is my understanding that the function of the CEO is to manage and support the revenue officer, the operating officer, and the financial officer. It's not his job to do anything else other than to find ways to support those three. Okay. He can do sales and work on bigger projects, deal with strategy and so on, but really his goal is to support them. So he will take about 25% of the total bonus pool, revenue 15, CO 15, and then you've got a 25% balance for the rest of the company. I generally just keep a 5% reserve pool because there are always things that come up and you want to be able to have some capital to be able to offer to other people. All right. And then you put it over here, let's say that the head count of the company, let's assume you have 15 people in the company. So that kind of gives you a guideline in terms of what might be available based on this operating income. Okay. One example of what the pool might deliver, right? So the question, the main thing is not so much the total dollar amount. The primary focus over here is the functional split, right? The part that I found really works very well is when you tie each category's compensation to the success of the other two departments. In other words, the revenue officer, he keeps 50% of his comp is going to come from what he does within his own department, but he also has to have an incentive to ensure that the COO and the CFO also achieve their goals, right? And the same thing with the COO, right? He has to make sure the CRO and the CFO and the CFO, the CRO and the COO. So the idea is that you're tying their compensation together. That is going to effectively remove the potential conflict because now they know they're working towards a common goal because all of their comp is tied with one another. It also becomes self-regulating. If someone is not doing their job, it'll come up to the surface immediately.
Oh, yeah.
Very, very quickly. So that will help the CEO also understand what the weak point is and surface what exactly is not working properly, and also it makes it less uncomfortable for the other two categories or whatever to be able to raise the issue because it becomes immediately evident in terms of the way the compensation is being split up, right? So that's on that side. It could be that they're sharing on the upside of the equity. We talked a little bit about equity, equity sharing in terms of the way we run our business. And that is we take a piece of the growth of the value of the enterprise value of the company. Could be also on the profitability of the company. So let's call it, pseudo phantom equity and what the target is. So for example, the company value today is, let's say, $15 million, right? So you might have, phantom equity of approximately 5% or 3% or 2%, whatever the number might be in terms of the work that you do, right? Now, what I would say is you can't just put a blanket number over there. And the reason you can't just put a blanket number is because you have to have some guardrails. What happens if two out of three succeed, but one doesn't succeed. Does he get this bonus even though he didn't achieve a minimum goal? So we put thresholds. So we basically say on the KPIs, if they don't reach 80% of their target, they get nothing. At the same time, if they exceed the target, then we comp them even more. We bonus them up to 120% of what the target is. So the idea is you're really driving performance and working together to push, the corporate goals, or I should say the owner's goals. And again, the owner's goals can be different. It might be focused on distribution, it might be focused on, exit value, could be whatever it is that he's looking for. It could be that, you, for example, as advisors are really focused on making sure that you've got at least 100, 200,000, $500,000 to be able to build some of the foundational stuff that doesn't necessarily reflect down in operating income or profitability. So, for example, if you're redoing their systems, so there's an expense that's attached to it, but it doesn't immediately reflect in the bottom line EBITDA or operating income. So the idea is you have the ability to parse out exactly what those goals are and tie them to the compensation metrics that are going to be there. And again, it doesn't always have to be financial. So
Yeah.
that's basically the idea. And this kind of gives a sense, when you turn around even to the employees, you're basically letting them know what the potential compensation is for meeting or exceeding their performance goals. That also applies to the employees, right? When you make it very clear in terms of what their job function is in the bigger picture, this is our annual goal. If you achieve the goal and you do what you're supposed to do, right, assuming that you meet a minimum 80% of your goal, this is the compensation that you're going to receive, the bonus at the end of the year. So you have everyone working and going towards a very clear, defined goal and objective, and it makes it very, very collaborative. I would say I tried it out about 7-8 years ago. Over the years, I refined it. And what I found is that the more clear the task is for the executive and the employee and how the compensation they're going to, what the compensation or the bonus structure they're going to get from execution, it's incredible how quickly it aligns. And the people that are not able to do it, as I would say like EOS, get it, want it, and can do it, those people surface to the top very, very quickly. It makes the ability to maintain and support the growth work that we do within a company, much, much easier.
Excellent.
I'm happy to address any questions that you guys have, but it should be pretty
This
clear.
is,
And you can adjust it, by the way. It doesn't have to be 25, 25, 50.
No.
You can adjust it to whatever you want. It just, for me, that's typically the way it's worked out. You just want to split the responsibility so they all carrying the equal weight. And from the perspective of the CEO, I give him a quarter of the overall company comp because my expectation is that it's his job to manage these three, right? And
Six words for you, Joseph. I agree, I like, and well done.
I'm happy to share it with you guys. I can easily, if you guys.
We had similar approach in the corporate world as to how you get things done and having to share goals and things. And you're right, being able to agree on them. One question: does the CEO set his own achievement percentage, or does, if there is, a board get to set that, or does the board do all of this?
Well, generally, when I work with my clients, the CEO and the owner are usually considered separate entities. I don't like to commingle them. So, from your perspective, if they are the same person, I don't know how you would say it would be set by the board. But yes, in general, I separate the CEO function from the ownership function. The view that we always take is you're an owner investor, not an owner operator.
Okay, good.
I love that. That ties straight in with the asset class perspective. Go ahead, Larry. Sorry.
Yeah, although you could have co-ownership in a COO role or other roles as well.
Of course.
Or have a president role in between. This is excellent. This is very much Roche Pharma Global button-up company did or used to do and probably still does. I had a client, $300 million pharma client that grew up in bigger pharma, and this is exactly, Joseph, what we did. I find they already did it before I got there. I fine tuned it a little bit to connect it to the actual elements they were responsible for executing on. So what were the top 3 priorities each were responsible for to drive those numbers that you have there? So this is much more advanced than where a lot of people are in our community. But my question is, how do you get them there? How do you get them to the point where they agree
Great
to
question.
this level of commitment and agree to your organization having a piece of that growth pie?
Is the question, how do I get them to the ownership willing to give up a piece of the pie?
That's the second part. But the first part is, how do you get a company of worth 15 million in enterprise value with their middle market behaviors to take on this type of large business mentality, mindset, and then action? Because
Joseph
it's a
tells me
transition
so.
for many in behavior.
Joseph just says so, and that's how it works.
Well, maybe for Joseph, not for the rest of us mere humans.
No, I think, look, the real issue that people have is they want to know that their work matters and they're appreciated for the input that they have in a company. The reality is the vast majority of people tie that to compensation. So I think that's really the delivery. The delivery is, look, the owner has, his goals and what he wants. You, as the employees of the company, also have what you want. Do I really need someone to tell me, oh, he's going to give me, an extra day off a year? Or I can, if I'm getting paid well, appropriately, and recognize for the work I'm doing, I can figure out however I want to use the money that I'm going to get. So I just find it makes it very simple and very clean in terms of how to drive behaviors that works for everybody. Because quite frankly, even if you're just an employee, if you're not an executive, you're an employee. Do you really want to be surrounded by other employees that are not really performing?
No.
Do you really want to be the mouthpiece that says, "Oh, so and so didn't do their job; it's their fault"? We want to remove that. You want to be able to. You want to make it self-regulating. So when you tie it to compensation and a very clear target, I think it happens on its own. You just need to introduce the idea. The hard part is the concept of the phantom equity. That is much more difficult to deal with the owner. There's many ways of dealing with it. Larry, I'm sure you have plenty of good ideas on how to introduce it. The way I really have that conversation is I basically take out 10 $10 bills and a $100 bill. And I give the owner, I say, here's $100. Or I give him the 10 $100 bills. I said to him, okay, give me back $10. He's like, I can keep it? Yeah. I said, you can keep the money. I said, just give me back $10. Great. Okay. I take another $100 bill. I give him $100. I said, okay, can I have another $10 back? Goes, yeah, great. You do it a third time. Great. Okay. How long do you want to continue doing this? And the owner's going to say, forever? You kidding me? If you give me $100 and I only have to give you $10 back, I'll keep doing forever. I said, that's exactly what phantom equity is. You're basically incentivizing your workforce to generate another $100 for you, and you're going to give them back an extra $10. Now, remember in the sheet that I was talking, in this sheet, I was just going to show you that I actually made this into an app. If you use Manus or whatever, anybody can basically take the calculator, brand it your own, and it'll create it into an HTML file. You can use it with your own clients. So you don't necessarily have to use an Excel spreadsheet. You can become interactive from outside.
You know, I love this. First of all, the philosophy, Joseph, is fantastic. I couldn't agree with you more. And winners want to play with winners, and in my book, I talk about dignity, and what you're really getting into, there are sort of two parts of the apple. One is we know how we're being measured. Every employee knows what the goal is, and their part in contributing to that goal. Love it. And there's something in it for them. There's the feel good. There's the playing on a winning team. There's understanding your role. And there's knowing at the end of every day, without somebody giving you a pat on the butt, that you have done your job well for the day, the week, the month, the quarter, of the year. And that, I think that I love what you've just described. There's an enthusiastic.
removes a lot of the potential conflict of underperforming employees. At the very least, for the executives of the company, you can quickly identify someone who's not achieving their goals and either provide them support or training or whatever it takes to be able to make sure. And that's really your job as a leader. Your job as a leader is to provide the people who work underneath you, or the people that you manage, the resources they need to execute their job. So the first path is going to be, what is it that you need? That conversation is, you're not hitting your goals. What is not working? How can I support you? What kind of resources do you need to be able to reach that goal? Because I don't only want you to reach your goal and get the bonus. I want you to exceed and make even more money. I'm excited to write you a bigger check. So they'll give you an answer, and then I guess you can have your process of trying to figure out whether or not you're providing the resources for them and they are achieving, or they're not able to, and therefore you need to replace them. But it removes that friction, that conversation. They're going to know by the time the second or third month rolls around and you've provided the support and the resources, and they're not able to achieve their goals. They know that they're going to step away. Usually they will already come up to the point and say, I think this is not working for me. I need to leave.
Yeah.
So it removes all of that friction. Anyways.
Joseph, do you get pushback on the goal sometimes? In other words, hey, I'm the CFO and I have net income, but somebody else is controlling revenue and somebody else is controlling gross margin. And so I only really am controlling the expenses at the bottom. And therefore, if it's, if we're already losing at the gross margin level, I can't win at the net income level, right? I'm just using that as an example. Do you get pushback on the goals, and how do you address those?
Well, you're always going to get pushback initially because nobody likes to have their compensation tied to anybody else. But I think when they understand that at the end of the day, a business is an organic entity,
Mm-hmm.
you cannot be selfish on the operating side, on the operation side, and not have an impact on finance or sales, right?
Yeah. Right.
If I don't execute my, the ops side, so sales is going to sell, but at the end of the day, the company is going to be weaker for it. The same thing with the other ones. So I think, as long as it becomes clear in terms of how all of these three primary components are really connected and how they're dependent on one another, then I think it's pretty straightforward. But I think it's generally the biggest problem, or the biggest challenge always has been, is that these three divisions are always siloed. Operations,
Agreed.
revenue, and finance, right? They're running their own divisions. They don't really talk to each other. By having this as a compensation methodology, it forces them to have the conversation. That's really more important. It forces them to have the conversation, discuss, well, how come I do this? Why are you going to do that? If we need to raise margins by 2%, where is that going to come from? How's it going to come from? Where are we going to allocate the budgets? Where do we really need to focus on developing to make sure the company is equal altogether? Because, as you all know, all of you are growth drivers. If you have an imbalance in the company, then you're not really able to scale. All the different divisions, or these three primary, both, revenue generation, operations, and finance, they all have to be able to grow together. Otherwise, you're not going to be able to scale. You're going to get imbalances. You're going to create, stress and breakage in the company. So it forces them to work together. But do I get pushback? Yeah, you get pushback initially, but I think when you walk them through, it doesn't take more than 15 or 20 minutes, and they get it, they realize it.
Hey, Joseph, that conversation there leads to other conversations about alignment, co-stewardship, interdependence. That one silo cannot succeed without the other. So it opens the doors to advancing how senior leaders work together.
Yeah, absolutely. But the question is not that they don't get it. They get it if you have the conversation, but how does it become tangible? How do you translate that need into something tangible that they can measure, they can understand? The only way I found is in compensation, because tapping my buddy in the back, great job, and that only goes so far. Or if he's not, or you. Let's do the other way around. When there is a problem and there is a conflict, Many of them will hold back and not say anything because they don't want to feel, they don't want to be, the one to the bearer of problems. This will bring it to the front and say, okay, something is not working here. How do we find a way to work together to make sure it works in all the different divisions?
What I love about your system, actually, Joseph, most is what you started with, and that is that we often say, okay, Mike, George, Paul, you're all going to work together. We're all a team. We're all trying to get to the same thing. And then we design compensation systems that disincent working together. Hey, sales, go out and get this and do whatever you want. And they're incented not to bring in the right stuff that supports operations. They're incented to just go get whatever they can get. Right. And so they bring in crap, and then operations is trying to sort it out. And operations says, hey, our job isn't to be as efficient as we can. It's just to get all the pieces out the door. And so, right. And so I agree with you. I love the tying it all together, that the compensation reinforces the message that we're all a team and we're all, rather than it actually puts a wedge in it.
100%. Listen, the growth driving objectives, Eric, your point is a great one. And Joseph, love this. The 24 growth driving objectives may be gears in the business engine, and we can have primary accountability for gears, and we have a structure for that. But the gears must mesh together to generate the outputs, right? The lagging indicators, Mike, like the lagging indicators of revenue, the lagging indicator of margin, the lagging indicator of profit, the lagging indicator of cash flow, and the lagging indicator of value. And so, Eric, what you've just described is the sales team has to sell what's on the shelf, and then operations has to deliver it on time and to spec that generates high customer sat, and they're all tied together. Love this.
But I would say one other thing. I use NOI for my target, but let's assume that you've got something on on one of the drivers, or I say one of the elements of the company that really needs to be addressed. So you could make it total enterprise value. Then now your target is going to be in operations. The primary area that needs to be fixed is operations, and it needs X amount of dollars in order to be able to fix what needs to be fixed. And it's going to add X amount of total enterprise value to the underlying company. So now it still can be the same thing. So you're now fixing the individual components within the growth drive objectives that you have for the company.
Right.
One by one or by quarter, and they're going to know, okay, if we achieve this and we resolve this and we still have the company growing in enterprise value, this is going to be the compensation for the next the next 90-day sprint. So you can break it up into sprints. You can break it up into any way you want. I'm just showing over here in a simple format on NOI.
Yeah.
Well, some of you are starting to suggest compensation based on strategic capacity. Well, that's a conversation we're having with the BEI community. Those wealth advisors are like, hey, man, you could just compensate based on increases in demonstrated increases in strat cap, and don't share your revenue. For those CEOs who have a mental block about being transparent about money.
You have to be careful. Whatever you can call it whatever you want. Don't call it strategic capacity. You can set it as strategic capacity, but you have to be able to identify something that everybody can identify with, because they're going to have to be able to track it. The trust factor has to be there, that you have some level of transparency. Correct.
Yeah.
If they don't see it, then they're going to think that you're fudging and manipulating the numbers because you don't want to pay them out and you just want to make them work harder. So you just have to be careful with that.
And Joseph,
happened to me.
I'm assuming that you're building in whatever. I know you used net operating income. If we've got a big project that we're implementing an ERP system, and there's a lot that's built into the budget, so it's built into the target, or you're normalizing for that, one or the other. Yes.
Correct.
Yeah. Got it. Okay.
But I turn the project of what we're trying to accomplish into a tangible number like enterprise value, the change in enterprise value. In other words, even for example, you have compiled financials, and then you have audited financials. So this 9-day cycle, we're going to make sure that the finance department is structured properly so that we can have audited financials. What does that have an impact in terms of the enterprise value? That becomes the delta for the quarter or for the 90 days. or it could be 180 days, whatever it is. And this is the compensation that's going to be attached to it. So they're going to get a piece of that growth. Doesn't necessarily have to be NOI or anything else, but it has to be something that they could tangibly capture and follow.
I'm just thinking of the Fortune 500 problem that quarterly results matter. And if quarterly results matter, then you don't make the investments always that you need to make to get to what you need to get to, right? If short-term matters longer than long-term, you don't make the smart strategic play that gets you to where you want to go long-term. So you got to balance those two, right? And so there has to be some oversight by ownership that builds the budget with the right investments that are going to get us where we want to go long term, even if they have a disincentive short term and they're normalized, right?
I totally agree with you. And that's why, despite everything I said, that you can apply any type of metric that you want, to guide the short term. For me, at the end of the day, it's NOI, because if it drops, then no one's going to get compensated. So it's not just about achieving the next level goal. You've got to be able to maintain what's already there. Otherwise, there's no comp.
But to your point, it can be NOI within the budget structure that includes some investment in these three projects that are going to get us where we want to go long term.
Well, let's stay with that, Eric, a little bit more. Joseph, you have 25% for company wide, because now the CFO, COO, CRO have to align their teams around this as well. And how do you use the company wide component? And I share that because a lot of companies do not share even below CFO's, the chief officer role, net operating income in the importance, or EBITDA, or any of the form of profit at that level.
Why not?
I'll tell you why I see.
Why not is the correct statement, but it doesn't happen so often that companies ownership does not share that. In some cases, not even with C-suite people.
That's fine. So then my response is, what do you expect from your employees? They have no idea where they're headed, why they're working for you, and what's in it for them. If you can't articulate that, then why would you expect superior performance from them?
Yeah.
You don't necessarily have
an area that all of us as growth drivers have to work on is change that mindset. It's a mindset that's, to your point, the way you just said it, is really detrimental to the growth of the company.
100%. Yeah. And we've all lived through stupid comp, right?
No, I think there's enough use case that you can pull from the internet to deliver to your prospects and your clients that make it very clear that the most effective and successful organizations, the primary thing is transparency. Everyone thinks that everyone cares about how much money you make. Nobody cares how much money you make. Everyone cares how much money I'm going to make. Let me know how much I'm going to make for the effort that I'm going to do. What the rest of the world is going to make, maybe they might be a little bit jealous, say, oh, why isn't split, more like this, like that? But honestly, if you have people like that, those are probably the people you should purge from the organization immediately. You don't want to keep them around. You want
transparency is a superpower, underappreciated superpower. I totally agree, Joseph.
Guys, I'm gonna disagree a little bit, not because I disagree with the point. I actually agree with the point, but I'm going to disagree from my experience out in the marketplace. And that is that the average person working in a small business, in a closely held business, doesn't understand financials enough and this is a fault, and this is what we need to work on, but they don't understand when they see a business that delivers $1 million of net operating income, that $1 million isn't going into the pocket of the owner. Right. And so I just say, not to defend all those owners, unilaterally and without some pushback, but what I see often is their employees if you showed them the P&L today, they would go, see, I knew that owner was making a lot of money and we're not getting any of it. Now, part of the problem is we're underpaying our employees. Part of the problem is we're not educating them on how the financials actually work, that the number at the bottom of the P&L is not the number that goes into the bank account. Those aren't the same number. right? But I'm just saying the owners have been burned too many times because when they did show that to people, then those people complained and came with their hand out for more money and wanted more of it, and that's been a problem, right? And that's what that circle to the bottom is what exacerbates the lack of transparency on financials.
The answer is, look, your point is well taken. I think it's a different conversation. I think the direction of where corporate structure is going to evolve over the next little while, it's probably going to be more like an ESOP structure where the employees are going to have, revenue share or participation in the overall company. I think that's kind of direction it's going to go. So,
I think you're right.
I
think
hope.
you're right, Justin. I think what's going to happen is when you choose transparency, you're choosing courage and you're choosing hope, right? You're aspirational. When you choose fear, which that scales infinitely, by the way, fear just grows. But I would say this to Joseph's point, I don't think we're very far away from radically changing how you share information with employees. AI is going to allow you to share more complex financial data in a way that an average employee can understand, and they'll be able to plug stuff into an AI and say, "Hey, how does this affect me if I do my job better?" And I think that's coming. I'm not disagreeing with anything that Eric's saying. I completely agree, experience-wise. I have this vision that's very similar to what Joseph's talking about.
Yeah, I
And
think there's an interesting dynamic here, guys, too.
I'm talking future, Eric.
It's no. I love the conversation, right? Joseph, first of all, what you presented was awesome, like really, really cool and right on point. I'm not taking anything away from what you presented. I love it. I'm just trying to talk about the practical reality of rolling that out to middle market companies and getting the right mindset. That's the point.
And something you hit on, Eric, that I agree with, and I would love to hear Joseph's perspective, all of your perspectives, is there's a difference between paying people what the market will bear and paying people what you can afford. And there is a profound cultural difference and performance. And Joseph, well, I'll just leave it at that. Eric, your point's a good one. And it's,
and I just add to that point, George, and this is where I was going. And Joseph, anybody weigh in on this, but Joseph, you're talking about your model, right? Employees want the upside, but they don't have a true owner mentality that they're willing to take the downside. So you can't say to an employee, I don't think most employees, hey, this is a down year. So instead of you making your base of 100,000 and a bonus of 40,000, I'm only going to pay you 30,000 this year because we didn't make very much.
That's really interesting. And to illustrate, Amazon is currently taking their senior leadership, and that's pretty deep, like their leadership, and saying, you know what, I know you made 300 grand this year, and you're going to make 300 grand next year. We're going to pay you 150 in cash and 150 in stock.
Mm-hmm. Yeah, there's a lot of ways to do it, but the thing we always have to remember is employees that don't have an equity position are justified in having employee mindset, right? It's
totally agree.
It's always interesting because, like, I was on the board of a nonprofit that everything in all of our mission statements, everything about what we did is that we were going to be the premier special needs organization in the country, everything. And we were. And yet we had a huge problem with retention. And when you look at the average salary that we paid all of our people, it was below the public school system. I pointed that out. Joseph, I think we had $1.5 million of cash we were sitting on. $1.5 million of cash.
And yet we can't afford to pay our people.
With 50 employees, right? And I said, well, why don't we pay more? They said, well, we pay the average. I said, show me where average is reflected in any of our job descriptions, in any of our training materials. For some reason, I wasn't on the board the next year.
I'd add one more thing. Think about the change of dynamics of the conversation with an owner or an executive from the way it is now, saying, I pay you too much, or I pay you 75th percentile, or having the conversation, geez, I'm annoyed that I didn't pay you more last year. How can I make sure you get paid more? Why? Because when I say it like that, I'm thinking to myself, this guy gets paid more. I'm getting paid more. And the owner is going to say, if my staff is getting paid more, that means I'm making a ton more money. So it changes the dynamic and the way you have a conversation with the people that are working in the organization. Again, it removes a lot of that negativity, which I think is very much inherent and conflict that's there.
Joseph, I think a lot of owners have an employee mindset because they look at all things around their income, right? And so they're beating up employees about having an employee mindset when their salary scales never endingly, right? And I always say to my clients is like, hey, at what point are you making enough money and we can start investing in the company?
Well,
Because
and
remember you
Mike,
can
man, that is a great point because that also goes to financial demographic. You are probably not going to see that in a 10, 12, $20 million business. You're going to see it rampantly if we just look across million and $2 million businesses. That starts to get baked out as the businesses grow. It must, because they have to attract better talent.
except in financial services.
Yeah. Well,
The exception that proves the rule, right?
I remember having a conversation with a venture capitalist. We were out playing golf together. And one of the things he said to me, we were 3 or 4 holes in talking about other things. And he said, when I invest in a venture, when I want to make that investment, I look at how much the owner is taking out. And if the owner is living large off their early stage venture, and they're asking other people to invest their money, I run the other direction.
Oh yeah, absolutely.
Right.
That's an Instagram.
Well, it's irresponsible. Yeah.
Yeah.
Right. But his point is valid in here, right? Mike, you said it. Joseph, you said it, right? Like there's been a couple of references to it. Is the owner smartly realizing that their reinvestment into the business, into the people and growing it is going to be better for them long term? They're only giving back $10 of the $100 they're getting, Joseph, to your very example, right? Can they get in that mindset and understand it, right?
Yeah. But earned income capture future wealth.
Right. Agreed. But what we have to change for everyone, the employees, and to your point, Mike, sometimes the employer, the owner, is the fixed pie versus let's grow the pie. Right. Let's make the pie bigger so everybody gets a big slice instead of if you take more, then I get less.
Yeah. No, it's always interesting. People talk about growing enterprise value, and I think with a lot of the smaller, I work with like the 20 million below. A lot of those, they're not about really growing enterprise value. They're about growing their income.
Yeah.
Good point, Mike. Good point.
Yeah.
And I'm thinking of a business right now that's a client, and their mindset is so steep in what you just said, Mike. It's hard for them to change. They have no pain right now or reason to change. A different client had plenty of pain. They are not profitable at all. All right. And the owner is in one of my CEO peer groups. So I started working with him. We employed our growth drive methodology. We took a look at the business, and he did not have a profit as an owner, a profit first mindset. He didn't understand it. He's driven by projects. That was his engineering background mindset. He built this business. It stalled. So step 1 was change his mindset. Step 2 was change his understanding of how to not only change a mindset, but how to operate differently. And step 3 was to get his entire management team, which is only a few people and a small co-owner, to change their mindset and move from a project mentality, how many projects can we get, to a profit first mentality. It's a work in progress, and we're about 6 months, 7 months into this, and we'll see the outcome, but he's turning the corner. And it begins by choosing projects from the start that won't be profitable and targeting opportunities of projects in IT that will be profitable and having that discipline. And it's so, yeah, Joseph, this is highly impressive. There are a lot of clients not ready for this level just yet, and take some mindset shifting to get there as well.
One of the things that it might be helpful, I don't know, your typical clients, but most of the people I come across have some type of investment portfolio. They might have a small retirement, retirement account or a small trading account. They might have, some form of stocks. It doesn't have to be very large. I think one of the conversations that I've had before, and I'm sure all of you have had the same. That is, if you have, if you bought a stock and it doesn't perform, doesn't do anything, and goes sideways for 1, 2, 3, 5, 7 years, how long are you going to hold that stock? What's the purpose of holding that stock? You have the risk, the equity exposure, the downside risk inherently there. Why would you keep it if it's not growing in overall value? I think the transition is going from owner operator to owner investor. You have to separate. You can still be the operator in the company, but your business has to be viewed as an investment asset. And you can say to even someone who's got a profitable company, say to him, I appreciate that the company is making $2 million, $3 million, $5 million a year. But if I had a $5 million stock portfolio, would I keep it if it didn't grow over the next 5 years and just kept generating the same amount of money? Am I comfortable with the risk, the exposure that somebody might open up another AI-based entity and it's going to disappear in 6 months? Or would I be comfortable, that tariffs come up and the company value can become half of what it is today? You're really basically sharing with them that there's a risk opportunity over here. They're exposed to risk, and they're not doing anything effectively to be able to manage that risk. And part of managing the risk is making sure that you've got continued growth and strengthening the foundation of the company. How is that reflected? It's reflected in the market cap, the market, the value of the company, the market price, enterprise value, strategic capacity, whatever you want to use.
That's the conversation, Joseph, is using AI and using leadership to show employees that even if they don't see it, they're still exposed to the risk.
100%. They're highly concentrated in an illiquid asset. And something that really resonates. So I have a lot of conversations with wealth advisors and insurance advisors in the BEI community. And one of the things that really resonates with them, and I'm sharing this for all of you who work with wealth advisors as COIs or as collaborators, when you sit down with a client, like, listen, you're 80% invested in an illiquid asset. As we morph your business, as we evolve your business so that it gets closer and closer to qualifying into the asset class, what we're creating is the ability for you to diversify your risk, harvest capital from the business, and put it into the market. Whatever you want. You have a Janus fund, bond fund, I don't care. But now you're diversifying your risk. And why are you thumbs downing?
Those are terrible.
No,
But no, it's just example, Mike.
George, you don't have to show only one example. Most of the people that we work with have been around since 1970. Pull off the list of the Fortune 100 in 1970 and ask them which one of these companies are still around. You have is your business larger than theirs? Is your company less diversified than theirs? They're not around anymore. So you better do something, because if you don't do something, the likelihood that your end result is going to be any different.
Well, look at what's happening to IBM right now. They are getting smoked.
Yeah, well, Joseph, your point's
not the only
a really
company.
good one. Yeah,
We
don't even look at the same. We don't even look at the same index, right?
I use Kodak. Kodak is my perfect example, right? You're not managing risk, and you're not diversifying your business, making sure that you've got control and have something available for CapEx to be able to make the company better, or for R&D, or for, even for you as an owner, taking some distribution. So you've taken some money off the table on a regular basis to be able to protect your ultimate goal, which is your retirement or whatever it is. Then, you're just
Joseph, man,
hoping that it's going to work out. So just buy a lottery ticket. Don't waste your time.
And when you bring up Kodak, it's a fantastic, right? General Electric, Kodak. Let's look at what happens to communities. Kodak, Rochester, devastated that community.
Yeah.
General Electric, Schenectady, devastated. When those companies
Caterpillar.
Caterpillar, devastate. These are communities getting destroyed. It's heartbreaking. I love that example. I was very close with the last CFO at Kodak, a great man who tried Yeah, he tried. And
Yeah, listen,
by the way, it was surrounded by so much bullshit that
and how about the automotive industry?
Yeah.
Right. How many
near and dear.
communities and cities were totally.
If you're on a pension, your exposure doesn't end.
Yeah, that's right. Hey guys, man, this was a fantastic conversation. Didn't see this one coming. Joseph, thank you. And we have 6 minutes left. I have to leave sharp at the bottom. Hey, could we do some key takeaways from this? Mike, I'll cover that topic as a podcast. Some key takeaways from today. Who would like to go first?
I'll
go. Go ahead, Paul.
Thank you, Joseph. What you presented was right in line with what I had at in the corporate world, including phantom stock and big spreadsheets to make us all work together. But the biggest takeaway I took from you was uh-oh to oy vey, owner operator to owner investor. I'll pass to Eric since he was ready.
Yeah. My biggest takeaway was I want to be Joseph when I grow up. I love this. Really, really pointed. We talk about all these concepts. I talk about all these concepts of getting people to play nicely in the sandbox, but I love that you put a system together that's more complex than just everybody gets a bonus. There's more to it that ties it all together. And I loved how the point I made in about the middle of the conversation, that it really came back to aligning the compensation with what we say. We want everybody to play nicely in the sandbox. Now let's design a compensation plan that will actually help them play nicely in the sandbox. I love that. So really nicely done, Joseph. I'm gonna go a little different direction and go Steve, and we haven't heard from you yet today.
Yeah, I snuck in about halfway through, and I want to say my big key takeaway, and it's something that I've kind of started to see more and more. To your point, we talk about all of these different subjects. We talk about, a million different strategies. Joseph taking one of these, structuring it out and making it visual to where you can actually see, read, and absorb it in a visual manner rather than just conversationally, I think is a lot more powerful, because I'll remember seeing that weeks from today. Will I necessarily remember everything that we, discussed without, reviewing the VOD? Maybe not. But this as an actual asset is something you can reference. It's something that you can show people. It's something that you can share very easily. So as we start to do these different conversations and topics, maybe it's worth putting together something visual and structural that can actually be shared.
Hell yes.
Oh, I'll throw it to Mike.
So, Joseph is everything I had hoped it would be when you alluded to it last week. So thank you for sharing this kind of stuff. I guess my takeaway is I don't have the horsepower on the finance side that everyone else on this call does, but I feel like I'm barking up the right tree because I've been talking about being a shareholder to all of my clients, that's where we want to get to, where we're not doing earned income, where we are existing as a shareholder. And that's going to be my thing. I think that your concept is presented better, better than mine. And so I will give you credit every time I use it because stealing is for the weak. I'm going to pass it to Joseph.
Awesome. You gonna make me say something? I would just say, look, the key takeaway is that none of us operate in silos. We all work in teams. As independent as we individually think we are, if you have a spouse, you have kids, you depend on a spouse, you depend on your kids to behave a certain way. We for some odd reason, our personal lives and our business lives operate in totally different spheres. And we have to understand that our business is like a spouse or a partner. And the people who work for us are like our kids. And we cannot operate. We're not independent of the people that work for us or work with us. And there has to be a way to recognize that. Compensation is one of them. It's not the only one. You have to be a good steward. You have to, be a good person and be ethical and moral. But I think part of it is, the compensation. There has to be a mechanism for people to realize and recognize that we are a team and we work together. So I just leave it at that.
100%. I'm going to echo on that. Carter, do you want to unmute and chime in? Okay. My key takeaway is, and if you do, great, just trample all over me. My key takeaway, and Joseph, you just touched on it, is that at the end of the day, analog is important, right? The relationship between people, the working dynamics between people, teamwork, meshing organizations together. There are so many things that I really liked in what you've structured. One of which, by the way, is you don't get the 80%. That's what I pay you for. If you can't get to 80%, what are we talking about? Because I would assume that everyone has agreed to these goals at the beginning of the period, right? So, love it. Analog, the collaboration. And by the way, Joseph's model does not require people to be collegial, right? It does require them to be mutually supportive. And you can hate the CFO, but you are incented to support them. And we had better all keep rowing this boat in the right direction.
Well,
I love
like
too.
25% of them if they do their job.
Yeah, right. This was what a terrific conversation. I'm so grateful to you all, to everyone who joins. Whether it's episodically or on an ongoing basis. Thank you. I have an idea. So thank you. Okay, guys, and it's halfway through, half past the hour. Thank you, and I hope to see you all next week. Okay, be good.